Hey, welcome back to my channel. In this video, we're going to talk about the basics of monetary policy. What is it? How does it work? Why is it important? So, monetary policy is simply the control of a nation's money supply and interest rates by its central bank. The main goal of monetary policy is to ensure the economic stability of a country by maintaining price stability, full employment, and stable economic growth. In the United States, the central bank is the Federal Reserve, also known as the Fed. It was created in 1913 and is run by the federal government. The Fed's monetary policy is set by the Federal Open Market Committee, which is a committee within the Fed that sets the direction of the economy. This committee meets 8 times per year to assess the economic conditions and decide whether to change the monetary policy. There are 2 primary tools that the Fed uses to influence the economy: the federal funds rate and the reserve requirement. The federal funds rate is the interest rate that banks charge other banks when they lend each other money. When the Fed wants to stimulate the economy, it will lower this interest rate, which makes it cheaper for banks to borrow money. And, in turn, they can lend that money out at lower interest rates to their customers. This encourages borrowing and spending, which stimulates the economy. On the other hand, if the economy is growing too quickly and inflation is a concern, the Fed will raise the federal funds rate, which makes it more expensive to borrow and can help to slow down the economy. The other tool at the Fed's disposal is the reserve requirement. This is the percentage of their deposits that banks are required to keep on hand at all times. By lowering the reserve requirement, the Fed increases the amount of money that banks have available to lend out, which increases the money supply and can stimulate the economy. Conversely, raising the reserve requirement will decrease the money supply and can help to slow inflation. Now, it's important to note that these tools don't exist in a vacuum. The Fed has to consider the current state of the economy and make decisions that will have the most positive impact while minimizing negative consequences. For example, if the economy is in a recession, the Fed may be tempted to lower interest rates to stimulate borrowing and spending. However, if inflation is already a problem, lowering interest rates could make it worse. Therefore, the Fed has to weigh the risks and benefits of each decision and choose the best course of action based on the specific circumstances. Monetary policy isn't just important for the United States. Every major economy in the world has a central bank that implements monetary policy to keep the economy stable. For example, the European Central Bank is responsible for the Eurozone, which includes 19 countries that use the euro as their currency. And the Bank of Japan is responsible for, well, you guessed it, Japan. Now, you might be wondering why monetary policy is important. Well, imagine you're a business owner trying to make decisions about hiring, investing, and expanding your company. If the economy is constantly in flux with wild swings in interest rates and inflation, it can make it very difficult to plan for the future. That's why we have monetary policy, by keeping the economy stable. Monetary policy provides the predictability that businesses need to make long-term plans and investments. It also helps to protect the value of our savings and investments. Imagine if you put your life savings into your retirement account, only to have it wiped out by hyperinflation. That's why the Fed's commitment to price stability is so important. By keeping inflation low and predictable, we can feel confident that our money will retain its value over time. So there you have it, the basics of monetary policy. If you found this video helpful, please remember to like and subscribe. Until next time.